Right now, central banks across Europe and beyond are orchestrating a gold accumulation strategy that could undermine the dollar's dominance, and the scale of these purchases is revealing a crisis of confidence that few are willing to discuss openly. In this video, you will discover how the surge in official gold reserves is more than just portfolio diversification. You will learn how this buying spree connects to deeper anxieties, mounting concerns about dollar weaponization, geopolitical fragmentation, and monetary vulnerabilities that mainstream financial media largely ignores. You'll also see how recent reserve shifts, sanctions policies, and currency competition are combining to create unprecedented pressure on the existing financial order. Pressure that could fundamentally alter how nations store wealth and conduct international trade. Stay with me, because by the end of this video, you will understand why the gold rush among central banks is not just about hedging inflation, why Europe's monetary authorities and their global counterparts are treating gold as essential insurance against financial coercion, and what this all could mean, not only for reserve currencies or bond markets, but for everyday people everywhere who depend on stable monetary systems. Welcome to the channel. If you want to stay informed about these crucial shifts, hit subscribe now. Right now, the movement by central banks toward gold accumulation runs far deeper than simple risk management. Central banks purchased over 1,000 tons of gold in each of the years 2022, 2023, and 2024, representing a pace more than double the average of the previous decade. For European and global monetary authorities, this represents a strategic response to currency weaponization, concerns about dollar reliability, and the need to secure assets immune from sanctions or political pressure. Gold now makes up approximately 20% of global official reserves at the end of 2024, surpassing the euro's 16% share for the first time. The United States dollar maintains its lead at roughly 47%, but the trajectory shows steady erosion. These shifts aim to reduce dependency on any single currency system and maintain financial sovereignty in an increasingly fragmented world. At the same time, the larger geopolitical context looms. Gold demand for monetary reserves surged sharply following Russia's full-scale invasion of Ukraine in 2022 and has remained elevated ever since. This expansion creates urgency behind the gold accumulation strategy. Every ton purchased challenges the assumption of permanent dollar supremacy, diversifies away from potential sanctions risk, and potentially destabilizes long-held monetary equilibrium. Meanwhile, concerns about financial weaponization are pushing nations toward tangible assets. The amount of gold held by central banks worldwide is approaching historic highs last seen in the Bretton Woods era, with 2024 reserves totaling 36,000 tons compared to a mid-1960s peak of roughly 38,000 tons. Countries are under intense pressure to protect their wealth from potential confiscation, and Western monetary authorities hope that integration into dollar-based systems will remain attractive despite these concerns. For global central banks, the stakes are enormous. In 2024, gold demand from central banks accounted for more than 20% of global gold demand, in contrast to around 1/10 on average in the 2010 seconds. The accumulation push from monetary authorities worldwide adds tension. Nations face a choice: continue holding predominantly dollar and euro reserves under potential political pressure, or accelerate gold purchases and signal reduced confidence in fiat currency systems. The outcome could reshape not only reserve composition but global monetary flows, currency confidence, and the balance of financial power. Central banks' response to currency system vulnerabilities has been deliberate and sustained. The National Bank of Poland was the largest gold buyer in 2024, adding 90 tons to bring its reserves to 448 tons, representing 17% of total reserves. Monetary authorities are not outright abandoning dollar holdings, but they are unmistakably diversifying. Instead, the global central banking community is moving strategically, balancing immediate liquidity needs with long-term goals to secure assets beyond the reach of sanctions or currency devaluation. This measured approach allows nations to avoid provoking immediate confrontation while still signaling that they will not remain fully dependent on Western monetary systems. For dollar-based financial architecture, this gradual shift creates mounting uncertainty. Reserve allocation patterns are changing, disrupting assumptions about perpetual demand for dollar-denominated assets and challenging the foundation of American monetary influence. Some analysts are observing shifts in currency composition, while others recognize challenges to established financial networks, which in turn questions long-term stability. The ripple effect is noticeable across sovereign debt markets, currency exchange systems, and even international lending institutions, all of which are tightly interconnected in a highly globalized financial system. Across policy circles globally, signs of transformation are beginning to crystallize. In a 2025 survey, 43% of central bankers indicated their own gold reserves would rise over the next 12 months, up from 29% in 2024, representing a record high. Markets, particularly in sovereign debt and currency sectors, are reacting with increased attention to reserve composition shifts. Financial leaders are monitoring closely, reflecting growing awareness about potential changes in dollar demand and what it means for interest rates and currency stability. Analysts are beginning to acknowledge that if this gold accumulation continues, it could fundamentally alter the architecture of reserve management, potentially impacting dollar liquidity, sovereign borrowing costs, and the structure of international finance. At the same time, the broader economic picture amplifies these tensions. Gold prices reached historical highs in 2024, surpassing their previous peak seen during the 1979 oil crisis when adjusted for inflation. Mint state gold. Modest shifts in reserve preferences can have outsized effects. International payment systems, foreign exchange markets, and sovereign wealth management all depend heavily on stable demand for major reserve currencies. So, any credible sustained movement toward gold alternatives immediately filters through to financial strategies and market expectations across multiple sectors. Investors, policymakers, and monetary leaders are watching closely. Research indicates that imposing financial sanctions is associated with increases in the share of central bank reserves held in gold, with geopolitical considerations increasingly influencing these decisions. The diversification into gold forces Western institutions to reconsider their assumptions about permanent reserve currency dominance, manage new risks, and potentially adjust monetary policies to maintain currency attractiveness. Meanwhile, smaller economies feel the pressure more acutely, as they must evaluate their own reserve compositions amid shifting global patterns. The unfolding scenario highlights the interconnectedness of global finance, where strategic choices by major central banks can ripple through currency markets, sovereign debt, and even the broader economy with surprising momentum. surprising momentum. The challenge at the heart of current reserve diversification is not simple portfolio rebalancing. It represents a complex reassessment of counterparty risk, currency reliability, and monetary sovereignty. Gold has no counterparty risk and cannot be printed, devalued, or sanctioned, which has driven countries like China, India, Turkey, Poland, and Singapore to ramp up their holdings. This fundamental characteristic distinguishes gold from all fiat currency alternatives. Between 2022 and 2024, central banks purchased more than 3,200 tons of bullion, a 3-year buying binge not seen since the 1,960 seconds. This combination of sustained demand and strategic positioning has fueled transformation in how nations conceptualize reserve assets. At the same time, the purchasing patterns continue to broaden. The Czech National Bank continued its steady accumulation, adding 20 tons in 2024, while activity was driven by a broad range of emerging market banks. Global monetary authorities' push for gold adds pressure on the delicate balance of reserve currency systems by attempting to secure wealth outside traditional channels. Nations are attempting to demonstrate that alternatives to pure fiat reserves are viable and necessary for financial sovereignty. While this might provide long-term strategic benefits for individual countries, it also creates systemic risks. If gold accumulation accelerates or currency confidence falters, vulnerabilities in debt markets and exchange rate systems could be exposed very quickly. The potential for disruption is real because the global monetary system is built on interconnected layers of reserve currency demand, sovereign debt holdings, and trade settlement relationships. Any significant acceleration in gold purchases, whether from coordinated central bank buying, a sudden loss in confidence in major currencies, or implementation of alternative reserve strategies, can trigger cascading effects. Financial institutions that are highly exposed to sovereign debt may face sudden repricing. Investment strategies dependent on stable reserve currency demand could experience sharp adjustments. Even international trade patterns could shift, affecting currency flows and capital allocation. Moreover, the pressure of these gold purchases coincides with other monetary stresses. In 2024, the share of the dollar in global reserves declined to 57.8%, the lowest level since 1994. Countries managing large foreign exchange reserves face complex decisions about optimal composition and risk management. The combination of record gold buying, declining dollar share, and geopolitical uncertainty creates mounting pressure. One significant event undermining currency confidence can amplify momentum across the entire system. In addition, geopolitical investments such as sanctions enforcement, monetary policy divergence, and strategic competition add another layer of complexity. Many reserve management strategies depend on the assumption of stable major currency systems and continued confidence in Western financial architecture. When major powers coordinate on reserve diversification, it can trigger a reassessment of currency risk, causing shifts to ripple through markets. The interconnectedness of global finance means that what starts as cautious diversification can quickly expand into structural change, making the central bank gold rush not just a tactical hedge, but a real and accelerating challenge to dollar-centric monetary order. The shift in central bank behavior is sending shockwaves through assumptions about monetary systems, reshaping reserve management strategies, and questioning long-held beliefs about currency dominance. Gold is now the second largest global reserve asset in value terms, second only to the US dollar, with central banks' gold stockpiles close to levels last seen in the 1,960 seconds. When major monetary authorities collectively shift toward tangible assets, it creates immediate questions about the sustainability of pure fiat reserve systems. Countries around the world that have structured their financial policies around assumptions of permanent dollar dominance face strategic recalculations about diversification, risk management, and long-term wealth preservation. Financial markets are highly sensitive to these developments. Gold's historic surge past $3,500 came amid a breakdown in political consensus about Federal Reserve independence, intensifying the search for non-sovereign stores of value. Investors are closely watching reserve composition shifts, sovereign wealth fund allocations, and broader currency markets that depend on stable demand for traditional reserve assets. Credible sustained gold accumulation could lead to currency adjustments, reduced demand for government bonds, and volatility in exchange rates. Economies that are heavily dependent on foreign capital inflows or on stable demand for their sovereign debt may feel indirect pressure as monetary patterns shift and reserve flows become less predictable. Countries across Asia, the Middle East, and even within Europe, which manage significant foreign exchange reserves, could face difficult choices about balancing liquidity needs with long-term security concerns. The potential long-term implications are significant. 76% of central banks project gold will constitute a moderately or significantly higher share of total reserves over 5 years, up from 69% previously. If accumulation continues, sustained implementation may accelerate de-dollarization trends, shift the composition of global reserves, and create new dynamics for currency markets. This could gradually alter the balance of power in international monetary policy, creating more distributed centers of financial influence. At the same time, countries and institutions that have built strategies around permanent reserve currency stability may need to fundamentally rethink their assumptions, adjust holdings, and adapt to a more fragmented global monetary landscape. Moreover, the ongoing accumulation encourages defensive positioning and strategic planning. Financial institutions are adjusting currency exposure, sovereign wealth funds are reconsidering allocations, and nations are evaluating optimal reserve compositions. As of the end of August 2025, central bank gold holdings overtook U.S. Treasury securities in total value, with gold holdings reaching approximately $4.5 trillion compared to $3.5 trillion in treasuries. The interconnected nature of international finance means that even gradual shifts in reserve preferences can amplify into broader economic consequences, affecting not only currency markets but also sovereign borrowing costs, international capital flows, and monetary policy effectiveness worldwide. In essence, the central bank gold accumulation is not just a diversification strategy. It is a global monetary stress test, revealing vulnerabilities in fiat currency systems, reserve architecture assumptions, and confidence in existing financial arrangements. Countries that rely heavily on reserve currency status or on stable demand for their sovereign debt may find themselves needing to adapt policies quickly, while institutions that failed to anticipate potential monetary fragmentation could face strategic challenges over time. The pressure could fundamentally reshape global monetary leadership, reserve currency competition, and the flow of capital, creating a world where decisions made across dozens of central banks ripple through financial markets with unexpected speed and cumulative force. One of the most important factors to watch in this unfolding situation is central bank purchasing patterns and gold price movements. Gold prices rose nearly 30% during 2024 and continued to rally in 2025, setting a record high of $3,500 an ounce in April. Announcements of new purchases, changes in reserve composition targets, or unexpected buying surges can immediately shift market expectations, causing fluctuations in currency markets, sovereign bond yields, and investor sentiment. Gold accumulation data itself provides concrete measures of confidence shifts. From 2022 to 2024, central banks purchased 3,220.2 tons, more than doubling purchases compared to 2014 through 2016. Signs that accumulation might accelerate are often visible across multiple indicators simultaneously. Expanded purchasing programs, rising allocation targets, or coordinated buying among multiple nations can all signal that monetary authorities are deepening their commitment to tangible reserve assets. Increased participation in gold markets and expansion of domestic storage facilities are also indicators that nations are building infrastructure for sustained diversification. Even movements in currency markets, sovereign debt yields, or reserve composition announcements can reveal strategic positioning that precedes larger monetary shifts. On the other hand, stabilization signals might include moderating purchase volumes, successful currency stabilization efforts, or renewed confidence in traditional reserve assets. 75% of central banks plan to reduce their exposure to dollar-denominated assets, up from 62% the previous year. Everyday people and economies could feel impacts through multiple channels. Consumers in countries diversifying reserves might see currency volatility affecting import prices and purchasing power stability. Shifts in reserve currency demand could influence government borrowing costs, affecting public services and tax policies. For investors, developments in central bank gold buying, changes in sovereign debt markets, and volatility in major currencies can affect portfolios, pension funds, and international investment strategies. Even sectors like international trade, commodity markets, and cross-border finance could experience changes directly affecting businesses and employment. The combination of reserve composition shifts, currency competition, and geopolitical tensions creates an environment where awareness is essential. Small changes in one area can cascade through monetary systems, financial markets, and economic confidence. Investors must evaluate currency risks carefully, and individuals need to understand how shifts in reserve management could influence purchasing power, interest rates, and financial stability. In this interconnected world, the consequences of major reserve diversification are rarely isolated, making it critical to monitor these key indicators closely to understand how they could reshape monetary architecture and economic relationships over the coming years. Central banks across Europe and globally are leading a historic shift toward gold accumulation, using tangible reserves as insurance against currency weaponization and monetary instability. Gold has firmly reasserted itself as a strategic anchor in the global financial system, now ranking second only to the US dollar in official reserve holdings measured at market value, with sustained accumulation extending central bank buying to 15 consecutive years. The response has been measured but unmistakable, with nations steadily building gold reserves while managing existing currency holdings. Meanwhile, the existing monetary system faces strategic challenges, from potential reserve diversification to reduced dollar demand to volatile reactions from markets concerned about currency competition. The transformation in reserve composition is more than a portfolio adjustment. It is a test of monetary architecture, currency confidence, and global financial order. Is this the beginning of a post-dollar reserve system, or will existing arrangements prove resilient enough to adapt? Only time will reveal the trajectory, but the stakes are enormous, and financial markets are monitoring every development. If you found this video insightful, make sure to like this video, leave your thoughts in the comments, and subscribe to our channel for the latest updates on central banking, reserve currencies, and monetary system shifts. Stay informed because the next wave of financial transformation could affect everyone.